Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler. Yeah, so, we keep hearing all kinds of conflicting information, what's going on in Washington. Cramer was talking about this on CNBC, and, I love-hate relationship with Cramer. He's big on, individual stock picking and all those types of things, and I think that's a lot of really bad stuff to do. Like I said, the Kellogg School of Management did a study on his stock selections, found you do better selling the things that he told people to buy. But I really like, some of the information that he gives, because I like the commentary that he engages in. But he had this talk about the bears, the idea behind bulls, people that think the stock market's going to go up, right? Got bulls and bears. Bulls that think the stock market's going to go up, the sky's the limit, everything's going to be great. And then you have bears that go, it's like Eeyore. It's another stock market downturn, you're going to lose money and it's terrible, everything's bad. Well, there was an article in MarketWatch that says even Wall Street's most committed bears expect a stock market rebound. And you go, well, why? Why would people that are bearish thinking that markets are going to go down, why would they think that there would be any kind of an upturn? And it's not the only place that I heard that. It was something that actually was talked about on CNBC. Check this out.
Anyway, I think you have to view this market as, this is apolitical when I put it this way, wins versus losses trump. The way that Canada blinked on electricity, win Trump. Ukraine, where he's now back giving them the weapons, Russia's not playing ball, win for Trump, meaning like, hey, listen, I'm flexible. Wins for Trump matter. We get the no government shutdown, win for Trump. Where are the wins for the other side, for the bears? Don't see them. Not CPI, looking for something. Can't find anything. I think that we're going to see a resumption of M&A. I think we'll see a resumption of the IPO market, which will be led by CoreWeave, which is going to be a very big deal that helps the data center. So
he's talking M&A, mortgage and acquisition. So you look at these markets and you go, hey, what's going on? Are people acting like, things are going to be okay? And so often we hear like terrible news, especially after markets go down. This is something that we teach in the very first workshop that we actually do for clients. We will actually walk through history, and we go all the way back to I wrote this workshop in the late 90s. And one of my most fruitful days in a library ever was the day I actually collected all of this information. I went back to the 1920s and I grabbed articles from the 1920s. I grabbed articles from the 1930s. I grabbed articles from the 70s and 80s and 90s. And what I wanted to point out was how the media was spending so much time trying to predict where things were going to go. And there would be this information back in the, in the 1930s saying, hey, you got burned by the market crash. Don't rush back into speculation. Don't jump back in. Don't be a fool. And, there were articles that were in the 1970s where Business Week had, the death of equities. And you say, oh my goodness, the death of equities. That doesn't sound good. Equities are dead. Don't invest in them. Then you had a 5-fold increase in value of the S&P 500, 8-fold increase in the Europe, Australia, Far East Index during the 1980s. So the point that I like to make was this, and I do this over and over again. The recession could be coming. Recession, these are reasons that the market's going to crash. And then I show how the market actually go up. Market's actually going to go up, and then it would actually go down. You might make of it that you just do the opposite of what the media says, but sometimes they're right. That's the funny thing. Sometimes they are right. And it's just random. You got a 3/4 shot that the market goes up. 1/4 shot that it goes down. I mean, what are your odds? I mean, you look at that and go, man, it doesn't make a whole lot of sense to try to predict what's going to happen next, right? But what we see here is all of this negative information after U.S. stocks went down. And you're seing all kinds of positive stuff on something that most people didn't own. which is emerging markets, value stocks, and emerging markets small companies, and international value companies, international small value, things that most investors within the sound of my voice, except if you're a client of ours, wouldn't have anything in, have done quite well, thanks. But the point here is he's saying that, what is going on here is that there have been all kinds of wins, but you don't typically hear about it. You hear about tariffs and how terrible they are. Oh my God, tariffs are going to be awful, and it's going to drive up inflation, and prices are going to go up, and it's going to be really, really bad. Well, that was addressed this week as well.
Okay, so let's talk about the actual pricing. There's lots of stories about how pricing is going to go up big. Isn't the truth that even though you've raised price, that we're really just back a year from where we were, and it was just last year was the worst year since 2010?
Yeah, it was, and it was even at pair with the COVID year, just to give you an idea. So we're not talking about bringing prices up. We are talking about bringing prices back to where you have a real business.
No, so his point there is that, a lot of the pricing in his industry coming back to where it was before, because the reality of it is, what's a company there for? It's there to make a profit. Now, this is something I talked about. Now this is, I hope I don't get too nerdy on this. I really want you to get this. One of the things I talk about is owning stocks to protect against inflation. Now, those of you who have been longtime listeners of the show, you will remember me saying this, but here is the point I like to make. We own stocks to protect against inflation. Yet sometimes you hear people talk about the stock market, and they talk about their fear of the stock market because of inflation. Now, wait a minute. That sounds like it's contradictory. Stock market could go down if we have inflation, but Paul, you own stocks to protect against inflation? Your brain, you feel like it's going to explode. You need to put duct tape around it. Because wait, what? Whoa, you protect again, but then stocks could go down because of inflation. Here's what he's saying. Remember that I often talk about that when prices go up, you don't want to be the first person to raise prices typically in your industry, because your competitors will be lower priced than you, and you will lose market share. Now, here's what he is saying. Eventually, you got to catch up to make your business viable. Let's go back to the 1970s. When you had, late 1970s and early 1980s, when you had lots of inflation. Now, remember, in the 1970s, you could buy a car for about $3,000. Now, look at today. No way on earth. If you have prices go up around you, and if you're the first person to be raising prices, nobody's going to buy your car in the 70s, right? But eventually, did people raise the price of cars? Yes. Because go to try to find one for, less than $30,000, $40,000, $50,000. Not so easy, right? So that is what we're talking about here. He's basically saying eventually you do raise prices. Now, he's talking about tariffs. If you have costs in the form of tariffs, you may not be the first person to want to raise your price for whatever you're selling to account for the tariff. In other words, you may suck it up in the short run as a business owner, and therefore what ends up happening is that you may take a hit to your earnings in the short run. Hence the reason stocks will go down, for the concern that earnings will go up, you see? But eventually raise prices you will. I sound like Yoda. Eventually raise prices you will. You will raise your prices to actually protect yourself. That's indeed exactly what he's saying here. And I think it's just fascinating when you look at it that way, you go, oh, yeah, now I see why stocks protect against inflation. Because remember, stocks typically sell, large U.S. companies anyway, for about 16 times earnings. Now that data goes all the way back to the 1920s. Stocks have always sold for about 16 times earnings. If back in the past, a dollar of earnings was all that you needed, let's say, let's take $1 billion, just to make it real. So you got a company that's selling for $16 billion. It's got $1 billion of earnings. And now it takes $2 billion to buy what, $1 billion used to buy. Okay. So you used to have $1 billion of earnings. Now it takes $2 billion to buy whatever used to take $1 billion to buy. What is the company going to sell for if the ratio will remain the same? Instead of 16 to 1, it will be 32 to 2. That's still a 16 to 1 ratio. Okay, so that is what we're talking about. What happened? What went up? 16 went to 32. What was the 16? That was the value of the whole company. Went to 32. So hence, what we see there is the protective aspect. But it's not a 1-to-1 ratio. It's not, bam, prices go up, earnings go up, and bam, your price goes up. That's not the way it works. And I love it. That's what he spelled out right there. Now, the other thing he talked about was interesting is the purpose of the tariffs. And, this guy, I love his accent, but check this out.
Trump would come to bring manufacturing back to the United States. And then, if you produce here, you're going to be okay. It's still tariffs are a matter of national security. There's no country without manufacturing and no country without steel making.
You don't want Chinese steel making our tanks and houses?
Of course, we can't afford that.
You think they'd work, half the time, 50%?
Yeah, look, Jim, we can't even think about that. We have to make things in the United States.
Navy ships, how'd they do if we have Chinese steel? Pretty good?
No.
Do I trust them?
Of course not. Of course not. And
no, just check out what he's doing there. Kramer's just playing. He's just having fun with them. And it was funny because it almost sounds like this guy is, taking Kramer seriously right there. But just, with that in mind, just listen to that little section again, just to hear how, because I love this guy. He's just answering him as if he's serious, but he's playing with him. He's being very sarcastic.
Things in the United States.
Navy ships, how'd they do if we have Chinese steel? Pretty good?
No.
Do I trust them?
Of course not.
Navy ships. We got to trust him if all the steel's being made outside the United States? I don't think so.
Of course not. And it's not. By the way, China is the biggest in terms of size, but others are pretty much the same. In percentage-wise, you have worse than China, like Japan, like Korea, like the Europeans. The entitlement is over.
Yeah, so his point is that a lot of the things going on right now, it's just right sizing and bringing things back to where this guy believes that they ought to be. Now, the question is, can we compete? Can we compete when other people are cheating? That's the question. And that is really what a lot of was being lost in the general media.
Can American manufacturing ever match the cost of production of a foreign producer?
Without subsidies and without currency manipulation and without all the kinds of cheating that are embedded in the number that we're trying to trick me and call, yes. Because we're the best. We're the most efficient. We have the highest technology. We use hydrogen. I came here not too long ago with Secretary Granholm to talk about hydrogen because we're using, not because we're trying. We don't brag about what we're trying. We're trying a lot of things. We only brag about what we do.
And I've been talking about hydrogen here for a while on the show, but the point I'd like to make here is I love what he said about just U.S. exceptionalism. I guess you would call it right there. But here's the thing that I talked about here on the show years and years ago, because this is something that was a big, big deal. If you go back in history, there was technology being financed by the Japanese government many years ago. And this technology, a lot of U.S. manufacturers were up in arms. Now, this was making the news like crazy in the early days of this radio show. And the point that I made on the show was this. I said, watch out, watch carefully, because the governments of other countries try to subsidize industries in those countries. And I said, but just mark my words, that what typically happens is when you get private industry and you let them loose and let them innovate and let them do their thing based on the idea of capitalism, based on the idea that the best will win. And if you keep the government out of it, what will happen is American manufacturers will actually end up on top. But they were so worried about it because these Japanese corporations were being subsidized by the Japanese government. What ended up happening, however, was that the U.S. innovated in technology in those areas much more rapidly than their counterparts around the world. Now, you might say, well, gee, then that means we just invest in U.S. companies and that's all we do. And I would say, no, that would be a really bad move. Because eventually those international counterparts would start to use the U.S. technology and would actually implement it themselves. Remember, don't ever forget that it was U.S. companies that were implementing Windows technology long before the international counterparts. And as a result, U.S. companies, their productivity actually started to ramp up before the international companies were actually benefiting from that ramp up in productivity. But ramp up they did, those international companies, because remember, investing isn't about necessarily who's the most profitable either. This is a misnomer as well. You know, people think, hey, the economy's better here in the United States than it is around the world. Just invest in U.S. companies. No. Investing is about letting somebody else use your money, and they have to pay to use your money. Just because a company is outside the U.S. doesn't mean that they don't have to pay every bit as much as a U.S. company does to use your money. So if we look back through history and we look at the returns of U.S. companies versus international companies, very, very similar for big companies. Slightly higher for international small companies versus U.S. small companies. Why? Well, you could put it this way. If there's more risk, there's more return historically, right? Now, this is the idea is when we put these portfolios together, you end up with a portfolio with less risk when you include them both. And I've seen way too many fund companies focus way too much attention, and investment advisors focus way too much attention only on U.S., only to miss out on a lot of things going on around the world that could reduce their volatility. Case in point, like I've been saying so far this year. All right, back here on the Investor Coaching Show, Paul Winkler. PaulWinkler.com is the website, and you can go there. You can book 15-minute phone calls with us, talk to us about what you're doing, and get an idea of what we do and how we can help you. That's what that is there for, and lots of video content, lots of all kinds of good stuff there. And here's one thing that we won't do. I promise that I will not engage in this kind of thing that you hear on TV all the time when it comes to, investing and where markets are going to go and what we need to be looking at, because, that's what the other guys do.
The one chart or one note that got a lot of interest this morning was Wells Gym. Remember the old underwear indicator?
Yeah. Big investment company right there. Okay. So, naming a big investment company, and they start off with the underwear indicator. Yeah.
In recessions, people, they're back at it. One of the slowest growing categories, they argue, in apparel, growing below trend, as people that they argue respond to macroeconomic pressures.
So, if you're worried about the economy, you just don't buy underwear. No kidding. That is literally what they're doing there. They're looking at what could, and the point is this. You'll have whisper numbers in the investing world. You'll have people look around and go, hey, what's going on here? And this sounds goofy. It really does. It does sound goofy. But this is why markets are so hard to beat. It's because people look everywhere for any kind of inkling of any kind of information to determine where markets are going to go. And when they start digging down and looking at underwear as an indicator of where the stock market's going to go, that they're looking all over the place for information. Just because this is how people figure out, hey, what's going to happen? How are people thinking? Because you don't get necessarily somebody saying, hey, I'm really optimistic about the future, or I'm really pessimistic. You watch their behavior. What are they doing? What are they not doing? What's an indicator? So what happens is when people do this, then that changes pricing immediately as soon as they see this information. And you can't get a leg up on it because it already gets built into stock prices. But it's just funny. I mean, you think the things that you would never think about.
Like that one, and remember the lipstick indicator? Are you buying lipstick? Well, the answer, no one's buying lipstick right now because as you see from the miserable numbers from anyone in cosmetics, but we have a lot of different indicators. The one I told you, the one I liked is that women not dyeing their roots because the colors cost so much.
Yeah, you don't buy underwear, you don't buy lipstick, you don't color your roots if you're a little bit worried about things. These funny things. But and I don't know if I'm quite getting this point across, and I'm trying my best to do this. If I'm trying to figure out where markets are going to go, I'm going to look at everything I possibly can. I'm going to look at the cash flow of the companies. I'm going to look at their sales. I'm going to look at investor behavior. I'm going to look at consumer confidence. And if I can't get information on consumer confidence, because that tells me if they're confident they may be buying things, I'll look at their behavior as far as what they're buying, what they're not buying. Are they buying lipstick? Are they getting their hair roots colored? Are they worried about the future? If you're worried about the future, you might not spend on things like getting your hair roots colored. And what happens is, as an investor, you got people that are in the buying side and people on the selling side. They're both looking at this information to try to get a leg up on other people. And because people are looking at everything they possibly can, it's hard to get a leg up on anybody else. Now, how about NVIDIA? I've often said that, companies, if they have on a scale of 1 to 10, their future's a 9.5, I'll often say, hey, look, if their future is a 9.5, but the future comes in at 9.4, their stock's going down. And that's exactly what this is about.
Investors got what they wanted from NVIDIA's GTC, a grand AI vision where total annual capex should reach $1 trillion by 2028, as both inference and training really just continue to require more compute. But NVIDIA's problem is that it has exceeded expectations for so long that it's almost becoming impossible to impress.
That is the point right there. Nailed it. If on a scale of 1 to 10, if I think that the sky is the limit and I think a company is really, really great, and I think that their future is a 9.5, but they come in at a 9.4 or 9.3, their stock will go down even though their future was phenomenal. That is just a great view of how stock markets work. Yeah, because we look at these companies, these magnificent 7, and we say, wow, these companies are great. And all of a sudden, information that came out and says, yeah, they're great, but maybe they're not going to be quite as great as what we thought they were going to be. And this is where investors get caught. They think, I'm on top of it. I own the best companies. I own the companies with the greatest future. I own the companies that are going to change the world. And you may. You may, in your investment portfolio, have companies with lovely futures. Wonderful. But that does not mean that they will perform that well. As we often say, companies often choose you. If I asked you to name a company, you'd probably name a company that you've heard of, you've heard about, maybe use their products. And people used to say, yeah, I'm going to be like Warren Buffett. I'm going to own companies that I know about and companies that I recognize that Warren Buffett gets on the board of directors for the companies. And he cheated.